Last time we were talking about calculating asset values, and you remember the fundamental asset values for investors, and the fundamental formula that we have in this is a present value calculation. And so the present value of some future dollars, we'll use a subscript to indicate how many years we have to wait to get that money, but the present value of any future promise of dollars is computed with this formula. 1 plus I to the t is in our denominator. And that I is our annual interest rate or our annual discount rate. And you know, there's a tendency to think that that's something official, and it's not official at all. Each investor has their own discount rate. And for you, you might say something like, you know, I would let my money go for 3% a year, and somebody else might say 3.5%, and somebody else might say 2%. And so each person has that right. It's your money to invest and your discount rate. So it's really not anything official. It's a personal discount rate for each investor. What we tend to do is look at the marketplace and let the marketplace tell us about what that discount rate is that most investors find acceptable. And so if we look out there in the marketplace and we say, oh, look, people are lending their money for 3 years at 2%, then we start saying, gosh, out of the hundreds of billions of dollars being loaned out, 2% seems to be acceptable to a vast majority of people. Then we start saying, that's about a reasonable discount rate. But you still could say, no, I've got to have 6%. Okay? And then this T tells us how long we have to wait. You remember this is just a date, like 2014 or whatever down here. But then this T here would be 2 years. Well, I guess this wouldn't be 2014. It would be, we have to wait X number of years, 4 years, 5 years, 8 years, whatever. And then this would tell us how many years we have to wait, and it's an exponent. Sir?
The discount rate.
Yes.
When you say, well, 2% is just not going to do it for me, I prefer to have 6.
Yes.
If there's nothing out there that gives that type of discount rate, then what do you just wait?
No, then what you say is this. I've got some money in the bank. I got $50,000 in the bank. My discount rate's 6%. And so then you do the calculations and you say, oh, I'd be willing to pay a certain amount here. And you go, well, nobody would sell me that asset for that price. Right. And so then you just leave that $50,000 sitting in the bank until something satisfies you. Okay. And that is really your choice. If you want, you can adopt their discount rate, everybody else's. Right. And if you do that, then what you'll say is, well, my money's at work, but I'm not being compensated for the risk I'm taking. And that's really what it comes down to. When you buy stocks and bonds and things like that, you're putting your money out there in a risky situation. And if you're not getting compensated for that risk, what are you doing? Why did you do that? Is it charity? Do you just say, I just hope General Electric does well, and I'm willing to let them use my money so they can do well, even though I feel like, all things considered, I'm not doing very well. No. So you just say, no, there's some risk attached to that investment. I've got to have 6%. If I invest here, I'm only going to get 2%. No, I'm not going to do it. And just keep looking. And maybe there's a place out there you want to invest in. Maybe there isn't. If not, keep your powder dry. Okay? So anyway, that's our options. But there may be other places you can invest. There are investments that are not just financial investments, but you can invest in your house. You could say, oh, I'm going to build, like a back porch on my house, or I'm going to improve my bathroom on the house. And so then I get some service. I've got the back porch, or I've got a better bathroom. And then when I sell the house, the value of my house goes up. There's a rate of return on that. Or, oh, I'm going to go and take an accounting class in college, and I'm going to learn a skill, and then I'll get promoted at work, and there's a rate of return on that investment. So these aren't all just financial investments. And sometimes the best returns are not financial in nature. Anyway, but good question, because that is what it comes down to, really, is your personal discount rate. And also what it comes down to, without even doing the calculations, is you just look out there and you say, look, here's what the financial markets are telling me, 2%. That's not acceptable for me. Don't do any calculations. It's like, if they're calculating and they get 2% and they say, that's worth it, then you know that that's not worth it for you, because you can only get 2, you have to have 6. So don't be like, I'm going to get the calculator out and work on this and see if somehow or another. No, the numbers won't add up. What I did last time then is I said, well, I guess I added one thing to this. This would be for a future payment. Somebody's going to give me some money on a certain day in the future. If we have an investment that promises a series of future payments, then we have a present value formula that's more sophisticated, where that we have, and then this is the summation sign from mathematics, and of course it's the Greek letter, what? Sigma, right? And so what we do is that we look at this, this summation of these future payments all the way from that first one to the last one. I'll put N up there whenever N is the final payment that we receive. And then here are these future payments, and we discount each one of them. And what this formula is telling us basically is we've got a series of payments. First of all, we take each one of them individually, we'll leave the sigma sign out, take each payment, discount it, and you get a number. And then you do that for all possible future payments from the first to the last, and then add all those present values up. Because this is just a present value, isn't it? And then we'll just add all those up. And when we add them all up, that is the present value or just the value of the asset to the investor. And what, to come back to your question, if you calculate all this and you say, hey, the present value of that asset to me is $48,000, and then its price is $50,000, you just say no. And another way of saying that is that the rate of return on that investment is not up to your discount rate. I mean, so those are really telling us the same thing. And if you calculate present value, say it's $48,000, and the price is only $47,000, I want it. And by the way, that is the answer. I want it. It's not like, I wonder if that's worthwhile. Because if we calculate present value, that is like, if I get my hands on this investment, whatever it is, it's worth $48,000 to me at this moment, because that's the present value now. And so if somebody says, I'll sell you this for $47,000, that would be like you handing $47,000 to somebody and they hand you back $48,000. They're both now. This is now money. And so if you hand over $47,000 now and they hand back $48,000 now, that's like somebody made you a gift, right? I'll take it. So there's no future thinking about this once, or additional thinking. Once we calculate present value, if it's greater than cost of the investment, go ahead. So anyway, not all, but many investments look like this with the series of future payments. Some investments, there's one-time payoff down the road, boom, that's it. But a lot of investments, and I mentioned last time, stocks, right? You get a series of dividends. Bonds, what you get is a series of, I call those coupon payments, coupon interest payments. Let me just kind of refresh your memory by drawing the picture. Bonds look like this, and I just mean in sort of general terms. There's this face value of a bond. They all have that. I also use the term par value or maturity value. Sometimes people use one term, sometimes another. Then there is a coupon interest rate on all of these. Every bond's got a coupon, okay? For example, 3%. And what that would say is, we will send you a check each year equal to 3% of the face value. And then they all have a maturity date. Okay, and that could be 1 year in the future. It could be a few months in the future, 3 months, 6 months. It could be a year, 2 years. It could be 30 years, and anything in between. Because really, what this bond is just an agreement between a borrower and a lender. And the borrower and the lender can just get together and work out any terms they want. And so, usually what happens is the issuer, that is the borrower, will put these dates on there and say, we want to borrow money for 30 years. And then they'll say, you want to buy these? And you can always say no, and I move on and buy something else. But anyway, maturity date, and like I say, I'll tell you what, there are one-day securities, and then they don't have the term bond, but we're using this in a generic sense. But there are one-day loans, 30-year loans, and every once in a while you'll see something a little bit longer than 30 years, but anything in between. And not only there are new loans coming out today, or new bonds coming out today, but there are loans and bonds made in the past, or issued in the past, that are trading out there. And so if you say, I want something with 27 and a half years to go to maturity, then maybe there's nobody issuing a brand new bond today, 27 and a half years maturity, but there's somebody who 2.5 years ago issued a 30-year bond, and that bond's out there trading in the marketplace, and you say, that's the one I'm going to buy. It's got 27 and a half years to go from today. So anyway, so what was I doing? This bond then is really a contract, and it says this: if you will give me some money today, then I will give you money back in the future. The borrower is saying, the money I will give you back in the future is this. And let's just say hypothetically, I'll put some numbers up here. Let's say this is $1,000. And let's say the coupon is, I'll use that 3%. And let's say the maturity date is 3 years. I'll use a different number because I don't want 2 3s in my number. Let's say 4 years from today, 4 years hence. And so this is really just a schedule or a contract, and it says, hey, we're going to send you some money. And what we're going to do is 1 year from today, we're going to send you 3% of $1,000. Here's future money that we're going to get from this bond. We're going to send you $30. 2 years from today, we're going to send you $30 more. That's what these coupons are about. 3 years, $30. 4 years, $30. So now those are your coupons. We promised you 4 coupons of $30 a piece, 3% of the face value. And then also on that day, the maturity date, we're going to pay you off. We're going to give you $1,000. And so really this, they say it's a bond, it's a contract that promises these future payments. And then what we would do is, using this approach, we would calculate the present value of each one of these. And we did that before, so I won't go back and do it again. Now, we're going to get a number. Here's divided by 1 plus I to the t power. You want to do one of these calculations? Let's do that. 6% was your discount rate. And so let's use 6%. This would be divided by 1.06 to the first power. Divided by 1.06 to the second power. 1.06 to the third. Why don't you get your calculators out and do that if you have a calculator with you?
So it looks to me that the higher the percentage.
Oh, you're thinking ahead. I don't like that in students.
Oh, well,
I want you to always
the
be,
greater the discount rate.
huh,
The greater
huh.
discount.
The higher your discount rate, the less you're willing to pay. Go figure. You don't have your calculator out.
I don't have it with me.
You don't have a pencil out.
I don't have anything with me. I was running a little bit late. I feel like.
Here's the deal. You brought your brain, and that's something.
It's more important to show up to class than bring the.
Okay.
bring the books.
The most important thing, number one, laugh at the jokes. I guess come to class, laugh at the jokes, take notes. So anyway, so far so good. Let me get my calculator out. %, huh? You're kind of a demanding guy. Anybody get any different numbers? Yes, ma'am.
Why that has 1.06, the interest rate is 3%?
No, ma'am. But it's a good question, but no, ma'am. Here's what this is, this bond. And let me just clarify the question. We got two interest rates here. One interest rate is this interest rate that's written on the bond, and another interest rate, 6%. See the difference? Now, what's going on? And the answer is this. This bond, this is not you. This is not your personal discount rate. This is a contract that says, if you'll give me money today, I'll send you some payments later. So I'll send you money. A year from now, 2 years from now, 3 years from now, 4 years from now, I'll send you money. And so then when they are telling you how much they're going to send you, they're using this number here, 3%, to tell you about what will be coming to you in the future. There's $30. And that is the end of that. That is no longer relevant after we know that $30. Then, so what somebody does to you is they say, hey, see this bond? Want to buy it? And you say, well, kind of like a lot of things, I will buy most things if the price is right. And so then they say, how much would you give me for it? And that's when you bring your own personal discount rate into the story and you say, you know, I will not let my money go unless I could get 6%. For you, it might be a different number. But the point is, you're not governed by this 3%. That 3% is just when they are telling you, hey, we'll give you $30 1 year from today, $30 2 years from today, $30 3 years from today, $30 4 years from today, and then we'll pay you off $1,000. And so this bond is really just a contract telling you about a series of future payments. Okay? Then what you do at that point is you decide what rate of return do I have to let my money go. And then I asked somebody and they said 6% for me. And so basically what you say is this. You know what? By the way, did anybody else, can you confirm this number? Is this right? Is it wrong? So we've got an investor who says, I'll tell you what I'll do. I'll give you $896.04 for that promise that you're making me to give me this money in the future. $896.04. And they say, okay. So what you do is basically, there's somebody out there and you loan them your $896.04. Would you give $896.05? One more penny? Just one more penny. If you would, then what you are also saying is, I don't have to have quite 6%, a little bit less. That's your business, but don't be putting 6% into the calculator if you mean I got to have 6%. I don't want 5.99%, 6. And if you'll take 5.99, use 5.99 here. Don't 1.0599. But if you put 6% in, that says I don't go a penny above that. That's it. So anyway, you make a loan, $896.04. Here's the money. And now from your loan, what you say to them is, you pay me these $30 payments and then $1,000 later. And over time, what do we have? 1, 2, 3, 4. We're getting, $1,120 out of this bond at different days in the future. And you gave up $900 almost right now. And on your $900 almost, $896.04, you're getting a 6% return. Now, here's another way of saying that, and maybe it will make sense to you. If you go down to the bank and say, hey, I want to put money in a savings account, what rate are you paying? And they say, 6%. And you say, okay, here's what I'm going to do. I'm going to put $896.04 in an account, and you're paying me 6%, right? And they say, that's right. And you say, that's great. Wait for 1 year, and you go in there and say, I want $30 out of that account. And they say, here you go. And you say, is it still everything I leave, it's still earning 6%? And they say, it absolutely is. And say, okay. Then you come back 2 years from now, you take out $30. 3 years from today, take out $30. 4 years today, you come back and say, how much is in that account today? And they would say, $1,030. And you say, give it to me. And so if this money is growing at 6% a year, and all the interest it generates growing at 6% a year, then what I'm saying is you could withdraw this series of payments. And finally, on the last day of this 4-year period, you'd withdraw the $30 and the $1,000, you'd take that out, and then they'd say, well, it looks like you've closed your account. And you say, I sure have. Want to do it again? Anyway, are we okay with this? Now, I gave you an example last time of a stock where the stock would be paying, in that case it was not a coupon payment, but a dividend. And what I said about that stock is it just keeps going on, dividend, 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 10 years, 20 years, 50 years. In theory, it goes on forever. I know nothing's forever, but what I also told you is when we're doing these calculations, 30 years is pretty close to forever. But anyway, there's no payoff day. There's no maturity date. Okay? More or less like with me, just no maturity date. I just keep on going and, don't mature. Grow up. So, anyway, and then what we did, you remember what we had is we had that infinite series, and then we calculated present value of that investment in a simpler way. We didn't have to do all these calculations. What we did is we just took that annual dividend and divided it by the discount rate of 6%. Well, last time it was 5%. Okay, and then with an infinite series, it's a little bit easier. This works with all kinds of investments. Let's say the investment is an investment in your education. Then this future payment that we would put up here is your pay increase that you would get as a result of having an education. It's like, how much do you get with college? Pay with college degree minus pay with high school degree. And so your future return on that education is the difference in your pay. And so if that's $10,000 a year, then this would be $10,000 1 year from now, 2 years, 3 years, 4 years, 5 years, and so forth. Right? Now, by the way, there's more return from going and getting a college degree than just a higher salary, but normally working conditions are better. Normally fringe benefits are better. So there are other things, normally less risk, less unemployment as you go along. There are a variety of returns. But the point is that whatever the investment is, there is some return up here that you're going to get year after year after year in the future, and then we discount those returns back to the present. What if it's a rental house? Then what you would do is, if it's a rental house, then what you'd say is, what's my monthly rent? And by the way, it wouldn't be a once a year payment, it'd be a once a month payment. But how much rent do I get each month? And then we would be dividing by a discount rate that, these would be 1 month, 1/12 of a year each time. 1/12, 2/12, 3, 4, 5, and so forth. 30 years would be 360 twelfths. But anyway, so you'd have a rent payment minus taxes, minus maintenance. If you, the landlord, are paying utilities, minus utilities, and so forth, whatever your costs of doing business are. But anyway, so you'd have this gross amount minus all these other things that you have to pay out, and then how much you left with at the end of the month. And then we would discount each one of those in the future back to their present value, and then you'd come up with some number. You'd say, oh, look, the present value of this house is, I don't know, $70,000 and $70,400. You got a number. Present value of all those future rent payments, net of expenses. And then you'd say, hey, how much are you asking for that house? And somebody would say, $64,000. And you go, I'll take it. No, you still bargain. Just because they say $64,000 and this is more, you don't say, I'll take it. Say, how about 51? And then you negotiate. But as long as the price is less than that, the final negotiated price, take it. Right? Unless there's a better one next door, and then buy the better one, let this one go. Better one in your net return. If they say, we want $70,500, and you say, let's negotiate, and they say, no, that is our bottom dollar. Take it or leave it. You say, $70,500, leave it. Every investment, we handle it this way. By the way, with a house, we would have these monthly rent payments. We could do either of two things. We could say, I'm going to own this house forever. And by the way, then we're projecting an amount of rent into the future. I'm going to own it forever. Or what you could say is, I'll make a schedule. I think I'm going to own this for about 10 years, and I'll have 10 years worth of net rent payments here. And then down the last number would be, when I sell this house, here's what I think I could sell it for. right? And more or less like the maturity value on the bond. But anyway, so then we just do the discounting. And by the way, this is hard to do with a calculator. And I don't mean to say the thinking part is hard to do. I mean, there's a bunch of buttons to be pushed. And then you want to change your assumptions just a little bit and you have to start over. It is so much easier to do on a spreadsheet. And once you make that spreadsheet up, then it's easy to go back and say, oh, I'm going to change my discount rate. Oh, I'm going to change my monthly rent. Oh, I'm going to, what if taxes are this much, and so forth. And it's easy to make those adjustments. But the thinking part is no more difficult for one or the other of these, and you set it up the same. Any questions about this? What I did tell you last time also, though, is when we get into these things, always remember this personal discount rate that you use should be one that reflects how much riskiness is attached to that investment. There are some investments very safe, like if you're buying a bond from the Treasury and it's a 5-year bond, you kind of have to think, I bet the Treasury's in business over the next 5 years and will make these payments to me. But there might be some company, it might be that there's some rental house that you're thinking about buying and, hey, I can rent that. Oh, the economy's kind of weak here in town, and so maybe it'll be hard for me 1 or 2 years from now to find a tenant to live there. Or, there's a lot of crime out here on the streets, and maybe somebody will run a car into this house or blow it up or something. I mean, these are far-fetched examples, but whatever risk is attached to this numerator, then we need to use a discount rate that reflects that amount of risk. And if I said to you, hey, what rate of return do you need? And you say 6%. I say, really? And you say, oh, just a second, tell me about the investment. And I tell you, and you say, no, not 6% there. 8% on that one. 10%, 12%, 15%. Okay, and so anyway, but we always want to match our numerator and denominator in terms of riskiness. Okay, let's go on and talk about, and it's really just a variation on this, fluctuation in asset values. Let's take the stocks to begin with. Down the hall, I don't know if you've noticed it, but down at the end of the hall, the economics department's got a television set up on a shelf there, and then we've always got this channel on there, the CNBC, that's got the stock market and all that stuff going by. And the prices are changing on those stocks pretty frequently, right? And I mean, in theory, they could change every few seconds. Usually they're a little more stable than that. But anyway, what causes those changes in asset prices? Well, the answer is, or asset values, I'll use that term. But if the asset value, and I'm going to get rid of the sigma just to make this look a little simpler, but there's got to be that sigma sign there. If this is our formula to calculate asset value, then when we say, hey, there's a fluctuation in the value, there's a fluctuation in P, it's got to be caused by something over here on the right-hand side, yes? Well, guess what doesn't fluctuate? 1, that's not going to change. And so the stuff that changes is, it could be that the amount of money we expect to get out of this stock changes over time. The amount of money we expect to get from the stock next year, and the year after that, and the year after that, and so forth on out. Our discount rate could fluctuate. Okay? And in theory, what could change is we could change the time horizon, how far out we think that we're going to get that money. This is pretty unusual, but it's not impossible. There was a period, I don't know, and I want to basically give you a short example about the T here, how that can change, and then go on and kind of leave that out of our story after that. But there was a period between World War I, WW1, and World War II, WW2. And in this interwar period, not immediately, because after that World War I was over, people said, no, good, that war is over. That was the war to end all wars until the next one. There was a period that came along here when people started saying, there's a lot of tension in Europe. A lot. These countries the leaders of the countries kind of hate each other. It seems like we're going to have another war. And what happened as we, not we, I wasn't alive then, but as we were going along in this period, what happened is people are just kind of going, oh my God, that last war was terrible, and this one's going to be worse. The bombs are bigger. Airplanes were a very new idea in World War I, especially in using them in war and things like that. They didn't do very much. Now the airplanes are bigger. Now they're dropping bombs. They can drop bombs on cities. And so what happened as time went by there, people in Europe just started thinking, is there going to be a future? Or are we just all going to die? And so then what's happening is this T for people, and they didn't say it this way, but if we want to go back and put their behavior, explain their behavior by looking at the formula, what happened was that T for people started getting shorter and shorter and shorter. Before that, they could say, oh, here's what's going to happen in 10 years or 20 years or 30 years, and all of a sudden they start thinking about, there's not going to be a 20 or 30 years. Time will still exist, but I won't be around, or our assets will be destroyed or be taken from us. And so what happened was these time periods started getting shorter and shorter and shorter that people would calculate a present value for. If you thought about, let's say you're living in, gosh, I don't know, Paris or someplace like that, and you think about, oh, I'm going to buy a rental house and rent it out to people. Really? For how many years? And maybe if you were back here in, I don't know, 1922, you might go, oh, I'll rent that out for the next 100 years. And then over here you might go, a couple years. And so at that point, if this period is just shorter and shorter and shorter, then yeah, we can, that has one effect, but don't forget, here's the T here, is it goes down, 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 down a long, long time, 5, 10, 15, 20, 50, 100 years, I mean, any number is possible. And if you start cutting that off and going, that's it, there is no future, then present values are going to be very small. So anyway, I'm going to leave that to the side and just come back and say most of these fluctuations in asset values that we would observe today have nothing to do with that time horizon. It has to do with these two things. How much money do we anticipate getting in the future from an investment, and what's our discount rate? And so when we look at these stock prices and they are fluctuating, what could cause that? How about this? A change, I'll use the delta sign for change in expected future earnings of a company. Let's say some company comes out and says, hey, we just developed a new product. Now, they've been working on this development process for weeks or months or years before, but we don't know anything about that. And now they come out and they say, we got a press release. We just developed a new product. It's a new, let's say a new miracle drug. It's a new kind of a computer chip. It's a new whatever, new kind of car. It's superior to everything else. Then we go, oh, wow, really? And we come back to our formula and we say, always before, I thought this company was going to generate dividends of, I don't know, let's say $3 a share per year. And now it looks like they're going to be able to generate dividends of $8 a share per year. And so when we get a new expectation about these future earnings, and it's an expectation, don't forget, we don't know. We're looking out into the future. But when we get a change in these expectations, we've got a new F that goes into that formula. And so up goes the company's stock value. Well, what about this? What if somebody is, and I'll stick with this idea of some miracle drug or a car or something like that. Suppose you're making a car and it's a great car. And the company stock price is going along and whatever, I'll go back to $3 here. You're paying a dividend of $3 a year. And maybe you're managing Toyota. And you say, boy, everything's great. We got this $3 dividend and our stock is trading at a good price. We feel wonderful about that. And then there's some other company, Ford or Mazda, and they come out and they say, hey, we got a better car than Toyota because they use the whatever technology, XYZ, and we got a technology that's better than that. And so here's some other company that releases information. That other company, if their technology is better and they can make a plausible story, the value of their stock goes up. But here's this company we're looking at, in this case Toyota, and we say, oh my gosh, the competition just released new information about what's happening to the value of new information about competition for our product, we're not going to be able to make that $3 dividend. We're only going to be paying $2.70 dividends if that other company over there is able to make good on its promise. And so now down goes Toyota stock because that F changed. What if you're selling Toyota, or what if you're managing Toyota, and here's our $3 dividend each year, and Toyota's got this car, the Prius, high gas mileage and stuff like that. And then what happens is something happens. There's a war in the Middle East, and the price of gasoline goes from whatever it is today, let's say it goes to $10 a gallon. Then people go, oh my gosh, $10 gasoline? I'm not going to buy one of these big gas guzzlers. I need a Prius. And then they go down and they're standing in line at the Toyota dealership. And then the people who run Toyota go, you know what we ought to do? Make more Priuses. And in the meantime, raise the price of the ones we got now. People still buy them. Profits go up, dividends go up, $5 a share. And if the dividend goes up, price of the stock goes up. Now, it'd be rare for the price of gasoline to go from where it is today to $10 overnight. But guess what? It's going from wherever it is today to wherever it is tomorrow. It's changing all the time. And there's somebody that's affected if the price of gasoline goes up 5%. There's somebody that goes, I'm going to buy a Prius. And if the price goes down 5%, there's somebody that says, you know, I was going to buy a Prius, but I think I'm going to buy that other hot rod. On a daily basis, we're getting new news, new information. And it's not only about the company that we are looking at, that we're trying to value its stock, but it's about the competition, and it's about other technologies. Maybe somebody comes out and says, hey, I'm going to start a new company up, and we're going to have light rail. We're going to have trains that just run between all the cities, like in metropolitan areas. And we'll just pick a city out, like Springfield, and home of the Simpsons. And then we're going to have small trains that just run between Springfield and within Springfield and all the outlying communities. And we're just going to go from city to city to city. And then people go, oh, okay, I don't need a new car. I'll ride that train. Down goes the dividend. So we've got news on what's happening with the company itself, its new technology, what's happening with competitors, what's happening to fuel prices, what's happening to totally different technologies. It could be that there's some change in government policy. The government might come along and say something like, you know what we're going to do? We're going to impose a $1,000 tax on all cars. All cars. If you do that, people are just going to say, some people, I think I'm going to just put off buying a car. I'm not going to buy it quite as fast. Toyota's not going to sell as many cars. Down goes their profits, down goes their dividends. Or they could say, here's a subsidy on buying cars. Buy more cars. People buy more cars, up go profits. So what I'm saying to you is there's any number of things. So when we go down the hall here and we look at those stock prices going by, and they're changing all the time. Why are they changing? Well, they're changing because there's new information in the world all the time. And it's not just new information coming out, but it's also new people buying into that. Like if you're a mutual fund manager, you get up, you come to work, you're sitting there, you're drinking your coffee, you're eating your donut, yelling at subordinates, whatever it is that keep them busy. And so then somebody comes in and says, hey, did you hear what Toyota did? And you say, no, I didn't hear about that. Well, this has been out for 15 minutes. This came out yesterday. Well, I didn't hear it. Tell me what it is. You tell them what it is. Oh, buy Toyota. Sell Toyota. And so what I'm saying to you is we don't all get the word at the same instant. We don't all react equally quickly. Some people take some time to digest that. So the prices are changing because of this new fundamental information, and also as people are buying into the story, discounting the story. Sometimes we go, oh, wow, that's a big deal. And then by the next day we say, that wasn't such a big deal. And then we kind of back out. And so these prices are fluctuating, number one, because of this. A second reason that they fluctuate, discount rates change. Okay? Oh, by the way, let me go, before I do the discount rate, one other thing. A change in expected future earnings of a company. But how about this one? A change in macroeconomic conditions. I didn't mean to get ahead of myself here. Now, those macroeconomic conditions will affect the price of, or the dividends, the profits of a company. But the thing about the macroeconomy is that affects pretty much everybody in the same direction. And so this would be, let's say we go into a recession, people might say, I'm not going to buy a Toyota, I'm not going to buy a Ford, I'm not going to buy a Mazda, I'm not going to buy, whatever. And so we just go down the list of what I'm not going to buy. And so in this case, it wouldn't be, oh, Toyota's up a little bit, Mazda's down a little bit, or anything like that. It'd be more like Toyota's down, Mazda's down. You get the idea, Ford's down. So if the macroeconomy goes against us, then we see that going down. I mentioned a change in laws and regulations. We're talking about stuff that can just change all of the time. A change in taxes. I'll say tax laws. And all tax laws don't affect companies the same. So some companies may be hurt a little bit by a change in tax laws, another a lot. Some company might be helped by it. Now, back to what I was going to say here is the change, I'll make this number 5, the change in the discount rate. Now, one thing that makes discount rates are interest rates. As I mentioned before, we kind of look out there at the world, we look at the financial markets, what are interest rates, and that's kind of telling us what the discount rate is that most people find acceptable. You don't have to buy into that, but you might go, everybody else is saying 3%. I'll go along with that because that's kind of common. I mean, who am I to be, disagreeing? And who you are is it's your money, so you can. But many people just kind of buy into that story. Discount rate, 3%. What can change this is, how about monetary policy? Federal Reserve might come out and say something like this. Today we are starting a new monetary policy. We're changing our policies, and those policies will cause interest rates to go up. Do they ever do that? Yeah. By the way, here's what they don't do, and we'll come back to this later in the course. The Federal Reserve does not do this. It does not say, the interest rate is 5%. They do not set interest rates for the market economy. I mentioned this before. Interest rates are established by supply and demand. And the Federal Reserve doesn't say 5%, 3%, 2.5%. The Federal Reserve does not set interest rates. What the Federal Reserve does is it has policies, and those policies supply more or less funds in the marketplace. And so by the Federal Reserve's policies, they can affect the supply of funds, and then that will affect interest rates. They don't set it to influence interest rates. But the Federal Reserve could say, we're going to start drawing funds out of the economy. We're going to make credit tight and credit conditions tighter. And as we do that, interest rates will go up. And if interest rates go up, discount rates go up. And if the discount rate is higher, then the value of asset values will be lower. What asset values? Houses, I mentioned rental houses, stocks, bonds. You said this before. Hey, if interest rates are up, discount rates are up, bond prices down. Exactly. But guess what? Interest rates start going up. It's very common for stock prices to go down too. And very common for housing prices to go down. And monetary policy, it's not the only thing, but monetary policy, here's the thing. A lot of things affect interest rates, which we'll come back to. A lot of things affect interest rates, but this is a big thing that affects interest rates, and it doesn't gradually have its effect. The Federal Reserve just comes out and says, you know what, yesterday our policy was this, today it's that. And it changed just now, and there's a public announcement, and it's on television, and it's as though somebody threw a switch. And so then, very often, when monetary policy changes, asset values will start reacting quickly rather than a gradual phase-in over the period of 1 or 2 years or something like that. Okay. Last point, and we'll close for the day. I'll show you in this formula, then I'll write a term down. If that discount rate goes up, then the value of this denominator is larger. We're discounting more, discounting those future dollars more, and so then the present value of assets goes down, right? Well, we have a term for bonds. Here's what we say. If the discount rate increases, then there's a decrease in the price of bonds. Other assets too, but now we're talking about bonds. And this relationship has a term. Anybody know the term? This is called interest risk. sometimes called market risk. And so what I'm saying to you is this, is that, a lot of people think, stock market, kind of risky. Stock prices can go up or down. Well, guess what? Bonds are risky too. And we're talking about that risk right here. If you buy a bond and you're sitting around, everything's great, and it's worth $896.04, and then all of a sudden discount rates go up, that bond that was worth $896.04, now it maybe is worth $840. Interest rates up, the value of bonds down, this is interest risk. And so bonds are risky as well, and they are risky because the market can turn against you. This is what we'll start with next time. So